Moving on to real estate, home prices continue to rise at a steady pace in April, keeping up with gains in value we've seen this year. That's according to the latest S&P Case-Shiller data out today. But could events like the Brexit vote and Fed actions cause potential buyers to flee? Hessam Nadji, Marcus and Millichap CEO, joins us now from Los Angeles to talk a bit about commercial real estate. Hessam, let me just ask you what you've seen here over the last few days and what you've heard as well from clients about the real estate market globally in light of this referendum last week.
Good afternoon. Thanks for having me on the program. Well, in light of the increased volatility and uncertainty around the globe, U.S. real estate, both housing and commercial, really stand out as a terrific alternative investment for three main reasons. One, the increased uncertainty and volatility is certainly lowering the interest rate profile here in the United States because of our really the global gold standard of safety that U.S. still retains. Number two, commercial real estate and residential real estate are not being overbuilt, which is highly unusual at this late of a recovery cycle. So the supply-demand is very well in balance thanks to steady but very consistent job growth that we've seen over the past 3 or 4 years and we continue to see. And lastly, it's the yield profile. If you look at the commercial real estate across all property types and geographic locations across the United States, the average yield is somewhere between 5 to 7%, depending on your risk tolerance. And so that spread over alternative investments is really causing even more interest in capital coming into commercial real estate. The market is not immune to the psychological effect of, the fear factor of what could this mean in terms of the Brexit effect and the psychological effect, but the fundamentals look solid.
Hessam, we had, obviously we've got very low unemployment here in the UK as well. The job market in London, until Friday at least, was fantastic. On Friday morning, I was at a trading floor and I heard from investors firsthand about projects getting pulled immediately after the Brexit vote results were released. Do you think we're going to see fewer office buildings completed, fewer investments started here in London?
I do, only because of the uncertainty and the developers and investors having to step back and measure the risk-reward given the unknown nature of the magnitude of effect on job creation in the UK. And that's not surprising to see in terms of sentiment. Regardless of what the short-term psychological effect may be, it's a foregone conclusion that Great Britain is still going to trade with the rest of the world, is going to trade with the rest of the European Union, and so it should work itself out. But I do think that on a short-term basis, there's going to be some major headwind.
Can investors use this, Hessam, as a leverage to renegotiate, to try and get more out of, for example, local governments because of the uncertainty? It's really hard to make a broad statement on that. It really depends on the locale. It really depends on the dynamics between the private-public combination of how a project is getting funded. And that's really much more of a local municipality decision. But I think at this point, there's going to be a pause in the marketplace in the UK. And I want to be very clear that the contagion of this uncertainty outside of UK is certainly not expected to affect the U.S. economic performance and clearly not commercial real estate performance or residential performance anytime soon. We have way too much momentum and solid fundamentals, even in light of a slowing economy, even in light of maybe slower job creation here in the U.S. Because the supply-demand balance is so favorable, the yield profile is so favorable, as I mentioned, we don't expect that any kind of a direct contagion unless something else highly unusual happens.
And yet, commercial and industrial loans were one of the weaker spots in bank earnings. How do you account then for your view versus that particular fragility?
Well, we've seen a lot more caution on behalf of lenders in this expansion cycle, rightfully so, given the magnitude of the Great Recession and the financial crisis we experienced just a few years ago here in the U.S. So lenders have remained very cautious. Underwriting of loans has been very disciplined. And although that puts a little bit of a natural barrier in transaction velocity, delays some transaction timing and so on, we believe in the long term that extra caution that's been baked into the U.S. real estate market actually serves to prolong the cycle. We won't get ahead of ourselves as we've done in prior cycles. Loan-to-value ratios, which is a very important indication of whether lenders are getting too aggressive, have stayed well within balance and well under the long-term averages. And therefore, I actually think that's going to help prolong the cycle. On the investor side, we are seeing more caution. Investors want a little bit more yield for the risk that they perceive to be taking given the global environment. And so that is apparent in the marketplace. But again, because of the yield profile, we're seeing a lot of interest from various types of buyers, private investors as well as institutional investors.
Great to have this conversation about U.S. real estate in a global context here, Hessam. I want to ask you about the role of China in all of this. We've seen a slowdown there, the expectation that that may continue. What effect is that having on the U.S. property market right now?
Well, whether it's Chinese investors, or in the last few days I've gotten a lot of questions about European investors and the run-up on the exchange rate versus the dollar and so on. If you look at the profile of most foreign investors coming into U.S. real estate, let's talk about commercial for a moment. The vast majority are families and private investors that are really looking to invest in the U.S. for political certainty, economic certainty, and a long-term investment profile. They're really not looking for immediate flipping opportunities or some kind of a quick appreciation. Therefore, whether the dollar goes up or down certainly has an effect. It's an ingredient in their formula, but it doesn't really change the long term. Having said that, foreign capital coming into commercial real estate accounts for roughly 15% of the total volume of sales, which is up above the long-term average of around 10%. So it's not, while it's up, it's not a significant market mover. And you see the high-profile investments that are made in the gateway cities like New York, D.C., L.A., San Francisco, and a few other markets. But the bread and butter private capital is really what counts. And it's not a needle mover in that category for the United States commercial real estate. On the residential side, places like Miami, like New York, really are affected, and they have seen a pullback on foreign capital coming in.
All right, Hessam Nadji there, Marcus and Millichap CEO, joining us from Los Angeles. Thank you very much.